So right now, foreign investors own like $35.1 trillion of America.
Which is just a massive number.
It's completely record-breaking. And, Wall Street is currently popping champagne over it. But what the trading desks are not broadcasting is that this massive American payday is actively, well, it's physically starving the rest of the global economy.
Right, yeah.
So welcome to the deep dive. Today we are unpacking a mid-July 2026 strategy memo from a highly regarded financial source known as Sovereign Dispatcher. And our mission for you today is to basically decode this massive hidden contradiction in the global markets.
Because that $35.1 trillion figure, I mean, that is the gravity well of our entire global financial system right now.
Right.
And while the headlines are, celebrating the U.S. breaking records for attracting all this foreign cash, we really need to look at the devastating ripple effects this has on what we call the frontier.
The emerging markets.
That's exactly. These emerging markets that are literally watching their liquidity just dry up overnight.
Let's actually start with the sheer scale of that gravity well, because the numbers in this memo are kind of hard to wrap your head around.
They really are.
Sovereign Dispatcher cites Merrill Lynch's July 13th capital market outlook, and it literally calls the United States the world's first port of call for capital.
Which makes sense when you look at the data.
Yeah, that $35.1 trillion figure from the first quarter of 2026, that is roughly 10 times the level of foreign ownership we saw back in the year 2000.
Wow. And the structural breakdown of that ownership is, it's even more revealing. It's not just passing speculation or hot money.
Right, it's baked in.
Completely. Foreigners now control 30% of the entire U.S. Treasury market.
30%.
Yep. And they own 37% of all U.S. corporate bonds and 21% of U.S. equities. I mean, this capital is embedded directly into the foundational pillars of the American economy.
Okay, so if you think about this like a massive neighborhood, the U.S. is essentially this one giant mega mansion on the block.
Yeah, I like that.
And every single bank in town is just throwing their money at it. Everyone wants to finance that one house.
Exactly.
But Wall Street is reading this as an unambiguously good thing. But if every lender is crowding into one single driveway, doesn't it completely warp the borrowing terms?
It does. It warps them entirely in America's favor. Economists actually refer to this dynamic as exorbitant privilege.
Exorbitant privilege.
Right. When the whole world is desperate to buy your debt, it creates this incredibly abundant, cheap source of financing. Like the U.S. government runs massive deficits, right? They are perennially borrowing money.
Right, constantly in debt.
But because of this relentless foreign inflow, there is a guaranteed constant demand for U.S. treasuries.
Wait, I just want to make sure we map out the actual mechanics here for everyone. If demand for U.S. debt is that high, Washington doesn't have to, entice buyers with massive interest rates, do they?
Not at all.
They can offer a relatively low yield, and the world will still just buy it up because they view it as the ultimate safe haven.
That is exactly exorbitant privilege in action. That foreign demand actively suppresses U.S. government borrowing costs.
Wow.
The memo notes that this specific flow of global capital is what's keeping the 10-year Treasury yield capped at around 4.56%.
Okay.
If the world wasn't just blindly absorbing American paper, the U.S. government would be forced to pay significantly higher interest rates to attract that exact same level of funding.
So Washington essentially gets this permanent discount on its debt just because of its VIP status.
Basically, yeah.
I mean, I get why Merrill Lynch and the domestic markets are thrilled about that. But the Sovereign Dispatcher memo sort of flips the perspective here. And this is where the logic gets pretty brutal.
It does.
Because if capital is flowing into the United States at these record historic rates, we have to look at the other side of the ledger. Like, where is it flowing from?
Global capital is a closed-loop system. It operates on basic physics.
Right. There's only so much to go around.
Exactly.
Yeah.
The International Monetary Fund laid this out pretty plainly in their 2025 arithmetic. They basically said, abundance for the center dictates scarcity for the periphery.
Which brings us to those emerging markets, the countries left out in the cold. But, if you're managing your own portfolio, you might look at your screen right now and think, everything looks totally fine out on the frontier.
It might look fine on the surface, yeah.
Because the memo points out that Merrill Lynch kept both U.S. and emerging market equities at an overweight recommendation. And the MSCI Emerging Markets Equity Index is up 21.7% for the year.
Right.
I mean, 21% gain looks like a thriving market, not a starving one.
Yeah, but that equity index is basically a facade hiding a much darker macroeconomic reality.
How so?
Well, the MSCI index tracks stock prices, right? Which can be driven by just a handful of mega-cap companies or, short-term trading sentiment.
Sure.
But to understand the true health of a sovereign nation, you have to look at the bond market. You really have to look at the plumbing.
Ah.
Sovereign Dispatcher brings in July 10th data from Gramercy, and the fixed income reality is grim. The actual debt these countries rely on to run their hospitals, build roads, finance their governments, it's dropping in value.
Let's break down those Gramercy numbers because they highlight this massive disconnect. The higher quality debt for these nations, what the memo calls hard currency investment grade, dropped 0.36%.
Let's pause on that term, actually. Hard currency.
Oh, yeah, explain that.
That simply means these emerging markets are borrowing in stable, major currencies, primarily the U.S. dollar, rather than their own local currency.
Oh, I see.
They do this to assure lenders that the debt won't just be inflated away by local currency issues.
But the trap there is that they now have to pay that debt back in U.S. dollars.
Exactly.
And because all the global capital is being sucked into that American gravity well you mentioned, those dollars are becoming incredibly scarce and expensive for anyone on the outside to get their hands on.
You nailed it. And we see that strain in the high-yield sector, too, the riskier emerging market debt, which barely moved. It only saw a 0.10% gain.
Wow, barely anything.
Yeah, the fixed income plumbing is stagnant or decaying, completely contradicting that flashy 21% stock market rally.
This is just wild cognitive dissonance happening on the trading desks. Like, Wall Street is telling clients to buy emerging markets based on a stock rally, while simultaneously publishing data proving that the world's money prefers to be in America.
Right.
That is like telling me to invest my life savings in a restaurant right after we just watched every single customer walk across the street to dine somewhere else.
That's a great analogy. They are recommending an investment based on the residual crumbs of a flow that has explicitly chosen a different destination.
Just crumbs.
Yeah. And this gets to the core mechanism of how emerging markets actually pay the price for America's privilege. Think about how the supply and demand for credit works.
Oh.
The exact same marginal dollar that flows into the U.S. and caps Washington's borrowing costs at 4.56%. That is a dollar that is intentionally not going to a developing nation.
And because the developing nation is starved for that dollar, they have to sweeten the deal to get anyone's attention.
Exactly. They're forced to what traders call clear wider.
Clear wider. Okay, in plain English.
In plain English, they have to hike the interest rates they offer by hundreds of basis points. I mean, full percentage points, just to convince lenders to take a chance on them.
Jeez.
Their cost to survive skyrockets.
Yes.
Simply because the U.S. is absorbing all the available liquidity. This actually leads to the most vital takeaway from the Sovereign Dispatcher memo.
Which is?
Read the direction of the flow, not the level of the index.
Read the direction of the flow, not the level of the index. I mean, that is a mental framework we should all be using. Because a booming stock index is just a lagging indicator, right? It tells you what happened yesterday. But the flow of capital through the debt markets is the plumbing. It tells you what is going to happen tomorrow.
Exactly.
So if the U.S. is this unstoppable vacuum, the only thing that could really power down the machine and give emerging markets a breather is a drop in U.S. interest rates.
Right, because if the Federal Reserve cuts rates, U.S. assets naturally become a little less attractive, and global capital might venture back out to the frontier, searching for higher returns.
And if you read the major financial publications, you would think that relief is right around the corner. The street is heavily pushing this narrative of disinflation. They're selling the idea that the Fed is going to be patient and perhaps clear the runway for these developing nations.
That's the narrative, sure.
But Sovereign Dispatcher looks past the public relations spin and digs directly into the actual minutes from the Federal Reserve.
Yeah, the recent FOMC minutes under Chair Kevin Warsh paint a very different picture than Wall Street's sunny strategy essays.
Completely.
The Fed is not unified, and they are certainly not universally preparing to cut rates. Warsh himself actually called it a family fight.
A family fight.
Yeah.
Let's look at the actual breakdown of that fight because it shows how deep the uncertainty goes. Out of 18 Fed officials, 9 of them favor at least one more rate hike.
Right.
8 want to see no change at all, and only a single official projected a rate cut. The federal funds rate is currently sitting between 3.50% and 3.75%. And Chair Warsh didn't even submit a dot on the dot plot.
Which is, well, for those who don't know, the dot plot is the visual chart where each Fed official anonymously marks where they think interest rates should be in the future.
Right.
So for the chair of the Federal Reserve to withhold their projection, that is a glaring signal of structural uncertainty. The committee is paralyzed.
And they are paralyzed because the upside risks to inflation are still very real. The memo highlights ongoing tariff pressures and, the conflict in the Strait of Hormuz. But here's where we catch Wall Street contradicting itself again. Merrill's strategy division is out there selling patience to investors. But Merrill's own internal economics table predicts the Fed funds rate climbing to 4.38% by the fourth quarter.
Exactly. One department is selling the optimistic dream, while the economics department is printing the harsh mathematical reality of further tightening.
Wow.
And if you are a sovereign nation trying to refinance billions in debt, you are refinancing against the math of that 4.38% projection, not the comforting adjectives in a weekly newsletter.
That is rough. We do see occasional flashes of green on the screen for the frontier, though, right? Like, the memo points out that African sovereign bonds were the only positive emerging market region for that week.
Sure.
The region was up 0.21%. Angola specifically was up 0.78%, and Nigeria up 0.44%. So does that mean the macro environment is finally improving for them?
No, it is a complete illusion of relief.
Really? An illusion?
Yeah, to understand why those specific bonds gained value, we have to look at global events, not fundamental economic improvement. Those African bonds rallied strictly because of an external shock to the commodity markets.
The oil markets, specifically.
Yeah.
Because Washington revoked the Iranian sanctions waiver, which caused Brent crude oil to basically spike towards $76 to $80 a barrel.
Exactly. And since nations like Angola and Nigeria are major exporters of oil, their sovereign bonds received a sudden boost simply because their primary export suddenly commanded a higher price on the global market.
So it's a temporary commodity prop. It has absolutely nothing to do with their underlying debt burden getting easier to manage.
No whatsoever.
Huh.
A barrel of oil holding above $76 masks the pain, but it doesn't fix the structural funding costs.
Wow.
If a nation is relying on random, volatile geopolitical spikes in oil prices just to afford its debt payments, that nation is balancing on a knife edge.
Okay, so we have established a pretty hostile macro reality. The U.S. is a $35.1 trillion liquidity sponge. The Fed is internally fractured with a bias toward holding or hiking rates, and the occasional relief out on the frontier is mostly a mirage.
Yep.
If you are an investor, how do you even approach this environment?
Well, Sovereign Dispatcher provides a really rigorous framework for navigating this. You basically have to sort the entire emerging market complex by one defining variable.
Which is?
How sensitive is a country to developed market interest rates?
Okay, let's actually apply that framework to specific countries, starting with India. The memo takes a constructive stance on India, which makes them kind of a fascinating exception to this whole global liquidity drought.
They really are. India is successfully defying the physics of this environment. In a world where global capital is desperately fleeing back to the safety of the U.S., India is building its own gravitational pull.
Almost like a second VIP club.
Exactly. The capital flowing into India is behaving very similarly to the capital flowing into America. It is sticky and it is strategic.
Meaning it's long-term investment, not just hot money looking to make a quick buck and run at the first sign of a panic.
Exactly the opposite of hot money. The only binding risk the author really flags for India is entirely localized.
The weather, right.
Yeah, the weather. A failed monsoon season could trigger severe food inflation, which would obviously put domestic pressure on their central bank. But from an external global capital perspective, they have insulated themselves beautifully.
Now, let's contrast that resilience with Indonesia. The memo is explicitly cautious here. They cite something called a double index downgrade trapdoor from major agencies like MSCI and S&P.
Yeah, this is a crucial mechanical risk to understand. Trillions of dollars globally are invested passively through index funds, right?
Right.
These funds are basically programmed by algorithms to hold whatever assets the major index providers, like MSCI, tell them to hold.
Okay, so if MSCI or S&P decides to downgrade Indonesia's rating, it triggers a trapdoor. All those passive global funds are mathematically forced to just sell Indonesian assets automatically, regardless of what human traders might think.
Exactly. It triggers this automatic avalanche of capital flight.
Yeah.
And Sovereign Dispatcher warns that Indonesia is facing this threat while simultaneously running their first trade deficit in 6 years.
Oh, wow. That's bad timing.
Very bad. They're deeply, fundamentally vulnerable to capital fleeing back to the U.S. center.
Then there is the situation in Pakistan, which the memo classifies under an asymmetry stance. And the geopolitical facts here translate directly into financial gridlock.
They do.
Islamabad was relying heavily on external financing that was intrinsically tied to regional peace. But fresh attacks by the Revolutionary Guard in the Strait of Hormuz, along with President Trump declaring the previous ceasefire essentially over, have just reopened the conflict entirely.
Yeah, and for a developing nation in Pakistan's position, geopolitics is not just about border security, It dictates their basic solvency.
Right.
The international community, like the IMF, will not wire billions of dollars in balance of payment support into an active conflict zone.
Obviously not.
The memo outlines that their financing hopes are completely frozen unless they can somehow secure a new package with immediate cash attached. The risk profile there is highly binary. I mean, either the money arrives or the system stalls completely.
So when you look across all these distinct risks, from India's monsoons to Indonesia's trapdoors to Pakistan's geopolitics, how do you actually structure an investment in emerging market debt?
Well, the memo.
Because Sovereign Dispatcher strongly advises preferring the front end of hard currency curves over long duration debt. Let's translate that strategy for people.
Sure. It all comes back to managing the risk of U.S. interest rates.
Okay.
When the memo talks about the front end, they're talking about short-term debt. So bonds that mature in just a few months or maybe a couple of years.
Okay.
Long duration refers to locking your money up in 10-year or 20-year bonds.
Got it. So if the U.S. 10-year Treasury is sitting out there offering a guaranteed 4.56%, buying a 10-year bond from a vulnerable emerging market offers almost no cushion for error.
None at all.
If U.S. rates stay high for the next decade, or if they climb even higher, you are trapped in a terrible illiquid investment.
Exactly. You cannot fight the U.S. Treasury market in a long-term staring contest right now. The data backs this up, too. Long-duration emerging market debt got heavily punished, dropping 0.56% for the week, simply because it is trying to compete directly against U.S. duration for that same global dollar. Short-term debt gives you flexibility. If the global environment deteriorates further, you get your money back quickly and can reposition.
You hide in the short end just to survive the drought.
Exactly.
This whole analysis, honestly, it fundamentally shifts how we should process financial news. When you are scrolling through headlines and you see the MSCI Emerging Markets Index up 21%, the immediate instinct is to assume the global economy is thriving, wealth is spreading.
But that instinct is so dangerous in this environment.
It really is.
Yeah.
Because you have to look past the surface-level stock rally and follow the actual plumbing of the bond market. You have to ask, who is actually paying the penalty for the abundance we see at home? The United States is throwing this massive, historically unprecedented financial party, and the exorbitant privilege means they get to borrow the money to fund it at a steep discount.
Yep.
But that discount doesn't appear out of thin air. The cost is being billed directly to the sovereign nations across the street who are suddenly paying hundreds of basis points more just to keep their lights on.
That's spot on. The central thesis of the Sovereign Dispatcher memo is that this privilege has a designated owner, and it is most certainly not the frontier.
Definitely not.
The frontier is absorbing the mathematical pain of America's abundance. And, stepping back to view the entire ecosystem, it forces us to confront a rather haunting structural question.
Which is what happens when the system finally reaches its limit, right?
Exactly.
Yeah.
If this $35.1 trillion U.S. capital magnet continues to expand indefinitely, just vacuuming up every spare dollar of global liquidity, what is the end game when the frontier completely dries up?
That's terrifying to think about.
Because the U.S. Center relies on a functioning global periphery for supply chains, for resource extraction, for international trade. So at what point does a thriving, well-funded center eventually begin to collapse because the global periphery it depends on has been pushed into systemic bankruptcy?
Wow. You can only starve the roots of the tree for so long before the trunk starts to rot.
Exactly right.
It is such a brilliant, unsettling perspective on how global capital actually dictates reality. Thank you for joining us on this deep dive. Keep questioning the consensus, always follow the flow of the plumbing, and we will see you next time.